Welcome to your real estate journey, expert tips for buyers and sellers. I'm Dolly Torres, a realtor and mortgage broker in the state of Florida and Kentucky. In this podcast, we guide you, teach you strategies, and provide you with advices to make informed and educated decisions in your real estate journey. Today, I am joined by Anna. She is a CPA and does strategies for taxes. So I'm so glad to have her back. Welcome, Anna. How are you?
Hi, Dolly. Nice to be back with you again.
I'm glad. So let's go directly to the point. Today, I wanted to talk about LLCs and partnerships and S corps and C corps and all of that. So sometimes, and regarding to real estate, sometimes from time to time, I get clients who want to invest in real estate, and they always said, "Hey, I want to buy this in an LLC rather than in my personal name." So from a tax point of view, is there really a difference between buying it under having an investment property under your personal name versus having it under an LLC?
Great question, and it's a question that we get all the time. People say, "I want to put my property into an LLC because it's under my personal name right now, and I really want to get those deductions that I know I can get through the LLC, right?" And it is the biggest misconception, because having a property under your personal name, having an investment property under your personal name, or an LLC gives you the same exact revenue, the same exact expenses, and the same exact net income, meaning you're going to pay the same taxes, right? Now, of course, you have the LLC expense of like opening the LLC, renewing the LLC. That is going to be an additional 50, 100, 200, whatever, depending on the state where the LLC is located, right? That's going to be the additional cost. Other than that, the only real difference of having your investment property under an LLC is that it's going to have liability protection, right? And what that means is that when you get, let's say you have your investment property is a house and your tenant fell within the house and they want to sue you, then if you don't have the property under an LLC, they can go against all of your assets, whatever is not under an LLC. Versus if the property is within the LLC, then the tenant can only go against whatever is within that property, within that LLC, which is the property.
And I always kind of go back between a real estate attorney and a CPA because they kind of go hand in hand, but they do two different things. Sometimes I go to a real estate attorney or a business attorney that practice business law. And they kind of said, "Hey, now you have to go to the CPA and ask your CPA for what would be the best way as far as tax purposes." And then the CPA sometimes kind of go back, "Hey, go to the attorney and see what they suggest." So you guys kind of do separate things, but always kind of come back together to have a full picture. So later on, we'll be having, I'll be having a podcast with a real estate attorney, and she also does business law. So look out for that. And we'll go ahead and talk about the same topic. Now, as far as when do you recommend having an LLC versus a corporation versus a partnership versus having a property or properties under their own name?
So this is a little bit of a complicated topic, only because the IRS has made it complicated, to be honest. Okay. So in reality, the legal entities, meaning when you register your LLC with a state, you have an LLC, you have a C corp, and then you have like PA, which is like doctors, realtors, that have like that kind of professional association kind of entity. But you don't have an S corp when you register when you're going to try to open a company, an entity, register with the state. You don't have an S corp, you don't have a partnership. Those are not legal entities. Partnership and S corporations are how you file with the IRS, right? So when you're registering your company, you have to pick between an LLC and a corporation most times. And I don't really like the corporation and we're talking a C corporation, we always want to go the LLC route. It's very simple, it's very easy, and it's passed through, meaning it's going to pay taxes. The tax bracket is going to be your personal tax bracket. So if you're paying 10%, right, or 20% or 15% at your personal level with the IRS, that's how much your income from your LLC is going to pay. Versus the C Corp, it has a set 21% and it keeps going up and down with these law changes, but you're paying 21% on that income no matter what. If you made $5,000, you're going to pay 21% of that. Versus if you have an LLC with a $5,000 income, it's probably going to be 10% bracket, right? So you see, yeah, you're already saving money there. And the second disadvantage of the C corporation is that it's considered an individual. It's not a pass-through entity. It's an individual on its own. It pays its own taxes on the income. And any distributions you make, any money you take out of that C corporation is going to pay taxes again, meaning you're paying twice the tax. So we try to stay away as CPAs, we try to stay away from the C corporation unless we have a valid tax strategy in which it is going to actually work. And we have a few strategies that we create corporations for, but for the most part, for rental income, we always want to register with the state as an LLC. Now, talking about partnerships or S corporations, when you open an LLC that has 2 or more members, that's when we're going to file with the IRS as a partnership. There's no documentation required. You just have to file your tax account, and your CPA is going to know to file the specific form because the LLC has 2 or more members. If the LLC is a single member LLC, you don't even have to report like any business tax return. You put it on your personal return. So you even save money there, you know? And then the S corporation, that's when you have to actually file a form with the IRS. And LLCs can be S corp, can elect to file their taxes as an S corp, and just like a C corp can also elect to file their taxes as an S corp. So if we see that the client has an S corp and it's not convenient, we may do the election for the S corp. And what the S corp does is that it helps with the LLC. You're paying taxes to the IRS. And you're paying your payroll taxes for Medicare, Social Security, right? And we're talking 15% of payroll taxes. So when we elect to file as an S corp, we save part of the income is reported as distribution, and that distribution only pays the IRS taxes. It saves 15%. That payroll doesn't have to pay it anymore. So I know it's confusing, but don't stress. Your CPA should know this, and your CPA will know how to guide you. And if it's a tax planner, they'll help you with the best entity structure.
And that's really difficult from my perspective, and I'm pretty sure for most of us in the U.S. We kind of choose whatever CPA, but whichever CPA, they normally don't specialize in strategies. And they just get in and out. You barely talk to them, mail everything, email everything to me. I'll do it, get it done, you sign, that's it. Most of us don't even check the taxes. Most of the CPAs don't even take their time to actually go over the taxes and the strategies to actually get it right, and for us to minimize our exposure. So for me, that's difficult, right? So it's really difficult to find a CPA that does the strategies at the same time. Now, from your perspective, what do you see in that world regarding, let's say,
Yes,
as far as the CPAs that you know, because I know you do taxes, but you are also a tax planner. That is kind of, you continue to, with your clients, you meet with them throughout the year. And even though other CPAs do that or say that they do that, they don't.
I just have a case. I have a new case. This entrepreneur, he came to me, and he has a business. He's also an employee and of a company, and he has 2 kids, etc. So he came to me and he said, "Anna, I have these tax planners. They're doing strategy for me, but in reality, all they did was file for the S Corp status, file my taxes as an S corporation, but they're not doing anything else. I'm trying to talk to them about strategies, and they're not really paying attention to me. And I said, they're not really tax strategists. Because when we talk strategies, we have like very high level stuff, right? S Corp is very basic. Most CPAs know about it. But you need to have somebody who really knows how to save taxes. And again, we have some sophisticated strategies that are not even like known to the CPA world, right? Like only they're really true tax strategies. So yes, Dolly, if you really want to, save on your taxes and find strategies and grow your wealth, you definitely need to find, besides your financial advisor, besides your legal counsel, you need to find a good tax strategist.
I currently I'm working with two clients, and one of them is starting their own company, and it's really difficult, or seems really difficult, even though they don't like their CPAs, to make a change. And then I have this other client that makes a ton of money, and they want to start investment. They probably be giving a whole lot of money down. So to a property, they probably have about $500,000 to cash to invest, in addition to obviously getting a loan out and stuff. When do you recommend going to a CPA versus going to a CPA that's also a tax planner? At what point? Or if they're just an employee of a company and they make good money, but they are a W-2 employee, like, what would be someone watching this right now, saying, hey, I'm in that situation. I could just go this way and, be in a safe spot. Or if I'm in this situation and if I go this route, I might not be getting the most out of the most advantages that's available, and they're not known.
Right. You don't know what you don't know, right? So until you show it, that's how we start working with a client. When we get somebody interested who reaches out to us for tax planning, the first thing we do is we look at their tax return and we see what kind of opportunities they have that they're missing out on, right? What deductions, what strategies, how much can we save them? And you'll be surprised. We save people $50,000 in 1 year or more, right? But to your question, who would be a good candidate for tax planning? I have a client. He's a W-2 employee. He makes about $160,000. He's paying about $30,000, $40,000 in taxes. He's our client. And he's saving taxes because he also owns real estate. So we make sure that we're putting every single deduction that he is entitled to, right? So that's number one. And number two, he has access to us throughout the year. So for him, the value is more than anything, having the ability to talk to a CPA who can answer questions that he has about real estate, he calls me, he's like, Anna, I want to buy this property. What do you think? I'm thinking this. Do I structure the deal like this? What is going to be more tax advantageous? Do I take money from here? Do I borrow from there? That access. So he's taking advantage of tax planning and advisory. So that's one case. Then we have other cases with people, like you said, W-2 doctors making $500,000 a year, paying over, I guess, over $100,000 for sure, $150,000, depending on the state, because then you have state taxes, right? So this doctor specifically is in California. Guess what? It's the highest tax state. So besides the $150,000 that he pays, to the IRS, he's paying $20,000, $30,000 to the state of California. So this is a person that can save $80,000 to $100,000 in taxes, right? So I mean, anybody can benefit from tax planning. If you're just a W-2 employee, you're paying $10,000, $20,000 in taxes, maybe it's of no value to you. But if you're already investing in real estate, if you have high income, if you're paying $50,000, $60,000, $80,000 a year, you already can benefit from tax savings. And one of the things that we do with tax planning is not just lowering your taxes, but talking about your growth, talking about retirement, talking about how you can make your money be as efficient as possible so you can keep more in your pocket. Or if you're putting money for retirement, when do you need to do a Roth? Should you do traditional IRA? Is a 401k better? I mean, we answer all of these questions, and we talk to your attorney, we talk to your financial advisor, so you don't have that cloud in your head of, oh my God, am I doing things right? Oh, what if I do this? What if I buy the property like that? You're talking about a client that has $500,000 in the bank, and I think, wow, that person, instead of putting all those 500,000 into one property, how about he puts it as a down payment into a multi-family and a bigger building, a bigger unit, a bigger property, right? Or what if he splits it up and he buys 2 properties with that money? The equity that in a few years that person's gonna have. And so we help realtors, we work with, the client, the realtor, that everybody, to kind of get the client to have more money in their pocket at the end of the day.
That's great. And one last question, kind of going back to the business. When would you suggest, because sometimes you hear videos online and you hear some attorneys mentioning, hey, you have to have one LLC per property to limit the liability. Now, if I bring that to a CPA, how many taxes are, how many filings are we going to have? How many Schedule Cs are we going to have, depending on how you file? So what's your perspective on it?
Right. So yes, a lot of attorneys will say put each property into an LLC. Of course, they're trying to find that legal protection for the client. So that would be ideal, except for the fact that for every LLC, you're gonna maybe have to create. Let's say that the LLC is a partnership, because you have the husband and the wife, or 2 brothers and 2 siblings. Then we're talking partnership. So for every LLC, you're gonna need a tax return. So when it comes to practicality, it may not work out. So what I recommend always is, it depends, look at your risk tolerance. What would be the limit for you to put into risk, let's say, into
like
one LLC?
Financially, right?
Say that again?
The exposure that you have financially on each,
Correct.
The equity on each property.
And it depends on your equity, right? If you have a property that, again, it has maybe $200,000 in equity, and then another apartment, it has $100,000 in equity, you're talking $300,000 in equity that you can put very well into an LLC. So you have the 2 properties into one LLC, and that's not complicated at all. And it's not much risk. But maybe somebody thinks that $300,000 is a lot of money, so maybe they want to put it into 2 different LLCs. Another option you have is, if you're talking husband and wife, for example, then we sometimes recommend, okay, put one property under the wife, the other property under the husband. It's single member LLC. It goes directly into your 1040. So that way you can put each of the properties into one LLC. But at the end of the day, it's not going to make a difference financially to you, because your taxes are not going to be are going to get more. You're not going to have to file more tax returns.
Okay. So based on what I've heard, just to make sure that I understood it right, is you not necessarily have to put one property into one LLC. You just have to manage the risk as far as how much exposure financially you have. If you have a property that is worth $500,000 and you owe $450,000, your exposure, it's really like $50,000.
Correct.
So then you can have another 10 properties like that. That's 50, 10,000 in equity and whatnot. So kind of looking at the overall risk rather than going directly to opening one LLC per each property. Now, obviously, if you have one property that it's paid off and is like $600,000, and then you have another property that you have another $500,000, then you might consider, just because of the exposure that you have to the liability, if someone were to sue you, they can go after all of that equity, right? Then you can go to have one LLC for one property and one for the other. Kind of looking not at the property itself, but at the value that people can go after you for. Did I understood you right?
That is 100% correct.
Perfect. I just wanted to have clarity on that because as a realtor and as a mortgage broker, I get this question asked all the time. Like, I'm not an attorney and I'm not a CPA, but you know what? Let's go ahead and ask the professionals who knows about this, who know exactly what they need to be doing, and then kind of let you guys know. But Nadia, Anna, thank you so much for coming out here. Thank you for your time. I really appreciate it. I know it's difficult to set out some time to get this podcast done, but I really appreciate you. You guys at home, feel free to reach out to either of us. Anna works in the entire United States and does also some foreign clients as well, who wants to invest in the US. And I work in Florida and Kentucky. So I'm here for you. Thank you guys, and I'll see you next time. Bye-bye.
Bye-bye.
Thank you.